just like the inducement, we say that inducement is an internal range liquidity that is close to a POI with a break of structure that is created with the purpose of manipulating traders. All right. Engineered liquidity is just like the inducement, but with small difference. They serve the same purpose of manipulating traders to either take early entries or to use them as liquidity, either for them to take early entries or to exit the market prematurely, whichever ways they are being manipulated out of the market. All right. Now, inducement, for inducement, price needs to break, sorry. For inducement, price needs to break structure. Of course, I don't know, your mentor already taught you what inducement is, so this is not supposed to be something different from what you have been taught. Inducement, break of structure, and then POI. It must be close to a POI, right? But for engineered liquidity, even though it is close to a POI, price don't necessarily have to break structure. All right. Price uses the concept of weak highs and weak lows to manipulate traders. I don't know if your mentor told you guys about weak highs and weak lows, but just in case it did not, maybe you guys can understand it from here. So a weak high is a high that failed to break a low. A weak low is a low that failed to break a high. All right. Now, price creating this low here and retracing back without breaking this high. This move that happened from here to this point, this move is supposed to come for this high, okay? To make whatever POI here to be valid, okay? So the failure for price to break this high causes price to come back for this low as a weak low. So this is a weak low. A weak low is a low that failed to break a high. Why a weak high is a high that failed to break a low. So price use the concept of weak highs and weak lows to manipulate traders to take early entries or to exit the market prematurely. All right. This is for bearish scenario. So when there is no inducement close to your POI, or when if the inducement is far from your POI, and price wants to use that POI. By POI, I mean point of interest. I'm sure that's not that is not a strange concept to you guys. When there is no inducement close to your POI, or if the inducement present is very far from your POI, price tends to engineer liquidity in order to use that POI, except price is not going to use that POI. But if price is going to use that POI, price will engineer liquidity. All right. Now, engineer liquidity is majorly for continuation. Please, it's majorly for continuation. I've not really used it for reversal. It is majorly for continuation. Like when the trend is already established, price tends to use engineer liquidity more for continuation. All right. Now, you may be wondering, or somebody will definitely ask this question. So let me just answer it. Sometimes price can engineer liquidity inside your POI, not close to your POI. Sometimes price can engineer liquidity inside your POI, like this. All right, something like this now. So we have our POI, and then price just takes a bit of an order, takes a bit of orders from the POI to engineer the liquidity. Now, some people are going to buy from here. All right. Some people will buy from here when price touches it like this. Some people will buy from there. But when they will not see price coming back, some people will break even. Some people will break even. While some people will some people will just close. Okay? The market is coming for SL, market is coming for SL. They will close their trade. While some people will break even, while some people will leave their stop loss like that. Definitely, I will leave my stop loss like that. I always like to see the end of it. So, but that thought of breaking even from this small move or closing early, that is the manipulation that we're talking about. Okay. Now, you look at this now, price engineer liquidity from the POI. Here, price engineer liquidity close to the POI. Let's look at both scenario from the charts. Where price engineer liquidity close to the POI, and where price also engineer liquidity inside our POI. Let me go to 30-minute time frame. I usually use these lower time frames for price continuation. Okay, that is when the trend is already established. Okay, so let's check for an example of what I mentioned earlier. So engineer liquidity, price engineering liquidity inside the POI, price engineering liquidity close to the POI. Okay, this is already inducement. Price engineer liquidity inside the POI here. Why inducement is far? Okay, from this POI, inducement is far. You can see where the inducement is. This is a loan structure. Don't worry, we'll talk about loan structure as the mentorship progresses. All right. Inside the POI. Now, some people will buy from here. But when they start seeing that price is coming back down, they can run away from the trade or break even. Small trade, it has not even moved, they are breaking even. That is why I hardly set break even. I hardly set break even because my break even depends on two things. Let me just add that. My break even depends on first, the mitigation of my POI. That is the level of mitigation that caused my trade to move. If price just tap into it a bit, I don't set break even because price can still come back to it to take orders properly. But if price mitigates everything completely, like this POI now, if price takes it up to like 75% or 80% of the mitigation, all right, and I actually caught the trade well, there is nothing left for price to come here for because the orders have been exhausted. But if price just takes like less than 50% of the orders, like not even up to half, you can see what happened here. Price did not even take up to half to engineer the liquidity. Price did not even take up to half here to engineer the liquidity. There, it is common sense. Price took only half. It didn't even take up to half here. So there may still be some orders left that can save price. So you don't just quickly go and break even because your trade is moving. It doesn't work like that. Second reason, maybe if I want to add a continuation entry, I can break even here or reduce my risk at the bottom because I'm taking a continuation. So those are the two reasons why I can break even. So that's why I barely break even. Here, price engineer liquidity here, far from, close to the POI. But here, price engineer liquidity, price engineer liquidity inside the POI here. Or here, price engineer liquidity close to the POI. Okay? If price wants to engineer liquidity inside your POI, it will just mitigate it a bit. Okay? Without really doing much. Without really doing much. Let's check for a few. Let's check for one or two more examples and then we'll continue from here. Price engineer liquidity from this POI. All right, like I told you, either the inducement is present or is absent. Either the inducement is absent or the inducement is far from the POI. So you can see what happened here. Price engineer liquidity inside the POI. Some people will still run away from this trade and watch the trade hit without them participating in it. Just a little touch on the other block and then price retraces back to the POI. This move, some people will oppose this move, some people will celebrate this move. But when price starts coming back, they will exit the market. Some people will break even. Just a little touch and they are breaking even. What happens to the remaining part of the other block? So having established that, price can engineer liquidity more than once. If you look at these examples that I showed you, let's go back to where we are drawing our, okay? If you look at what I've showed you here, price only engineer liquidity twice. Once here. Price only engineer liquidity once. But price can engineer liquidity more than once. For example, this is price engineer liquidity twice. Now, what are the things to take note of? There is no break or structure. Each high are protected. Each high is a lower high to the other. Okay? We have our POI. We have our POI, and then we have engineer liquidity, 2 breaks before the POI. Like what happened here. An example of 2 breaks is here. Okay, we have our POI. We have our structure order block, and then we have engineer liquidity. You can see that the inducement was nowhere to be found close to price. Close to the POI. And then price engineer liquidity on the way there. 2 breaks engineer liquidity. That is why I don't use limit orders for entry. Of course, there are traders that use limit orders for entry. They enter the market, they make profits, they are doing well. But I don't use limit orders for entry. I use market execution Because how the market gets to my POI is more important to me than how, the market coming there at all. How the market gets to my POI is more important to me than how market gets there. So it's not about market coming to my POI. How did it get there? All right. For example, to look at this two breaks engineer liquidity now and this POI, you will see that it is similar to what happened here. But what is the difference? Why did here not react? There is no engineer liquidity here. This price came straight down. Okay. So as you set your limit here for buy and it triggers, oh, you're in profit, congratulations. And then here you are setting another limit again, and then you are out. You will now call it manipulation. It's not manipulation. How price got here is different from how price got here. Here, price came straight. Okay? But here, price engineered liquidity. So the intention of price before the POI matters. All right? You don't just set limit order and then, of course, people who set limit orders, they know their reasons, they know what they are doing around that. Me that is using market execution, I know what I'm doing as well. All right. We also have three breaks engineer liquidity. In fact, this is my highest probability engineer liquidity that I trade with. Three breaks engineer liquidity before my POI. I've caught several trades with this concept, with this ideology. First break, second break, and then the third one. Before your POI. Three breaks. It gives your trade high probability, gives your POI high probability of playing out. For example, I used it here. Even here, it happened. It happened here. We have one break, two, and then three. Even from this POI, even with the inducements, price change engineer liquid. Here, I call this trade. This is the trade that got me my first car. I caught it with three breaks engineer liquid. We have the inducement all the way up here. It's far from our POI. Price had to engineer liquidity. Three breaks engineer liquidity before price got there. You can see the breaks, all right, before price got to the POI. And then the rest is history. I had all the trade. I had my trade all through this consolidation, keeping my invalidation here, all right? And price still managed to move to profits. Worked here as well. It worked here as well. Three breaks engineer liquidity. Okay. Before this confirmation entry came, price broke three, price broke three lows. Before this confirmation entry came, all right, price already giving you a clue that, okay, this is like a clue that, okay, something is going to happen on the buy side. Here, I used it as well. Before this POI came, price still broke three lows. Now, pay attention to the way I'm marking it out. All right. Most times, this is where you should be paying attention to. This trend, okay? Look at what I drew. Look at what I drew. The textbook pattern. 1, 2, 3. Okay. I did not include the break from this back, all this place. Okay. It doesn't concern this side. So whatever structure you have or whatever low you have this side is not what we are considering. We are considering how the price gets to the POI. Okay. How the price gets to the POI. That's what we are considering. This trend, the price created before the POI, that's what you should pay attention to. So whatever is happening at the back or whatever has happened at the back, don't pay attention to that. Pay attention to this side. Okay, because this side that you are looking at the breaks. This is not the first time I'm using, this is not the first place. In fact, 2025 was not even the year that I started using three breaks in general liquidity. I've been using it even 2024. All right. Price create these continuation patterns, but you may not be able to recognize them until, of course, you start studying. You start studying and reviewing your trades. Okay. When I took my first three breaks engineer liquidity trade, it was, I can still remember the trade. I don't know if my chart is going to reach there, because even as I'm using premium trading view, I don't know why my chart is limited. I thought that's one of the packages that comes with premium trading view. I have no idea. Where is it? Okay, here, yeah. This is one of the few trades that I took with three breaks engineer liquidity that actually made me to believe that, okay, yeah, it is actually a thing. Three breaks engineer liquidity is actually a thing, because that day we had FOMC coming. Yeah, FOMC came, price dropped to this candle, 8 p.m. and then 8:30 the buy went up. So during the day, I was looking at these patterns, how they were forming. I was waiting below here, and then price broke three lows and this buy happened. I just said, let me try it and see whether these three breaks will actually count. And it did. It did. Even here, same three breaks engineer liquidity from this end before it got to this POI. Although there's a loan structure entry there that also supported the trade. But if you used only three breaks engineer liquidity, you would have been able to enjoy that trade without any other thing added to it. It is not only for buy that the three breaks engineer liquidity works, or it's not even only for buy that engineered liquidity works, please. For sell, it works too. Price engineers liquidity and sell. So it's not only for buy. Let's check a few examples for sell. Like here now, it was engineered liquidity that caused this sell. Okay. Our POI. and then price engineer liquidity inside the POI. And then the rest is history. Here, even with our inducement, price the engineer liquidity inside. Here, price engineer liquidity inside our fair value gap, or even close to our fair value gap. This was one of the surprising trades that I've taken so far. Like, I actually waited for this trade to, if you check my Twitter, you will see it. How did I not close, seeing that price was close to my SL? I have no idea. You tell me. Throughout the day, price was threatening my SL. I said, I must wait for it to hit SL. Now imagine that I actually closed this trade. And then this happened. I know that some of you are guilty of that. We take a trade and the slightest thing, you're out of the market. This engineer liquidity for buy. Well, we are in a bullish trend, so we should not expect much from the bearish side. But of course, price engineers liquidity for either ways, for buy and for sell. Okay, this is 3 breaks engineer liquidity. 3 breaks engineer liquidity before the POI. So we have 1, 2, and then the third one before the POI. Notice that inducement is absent and price wants to use this POI. That is why it's engineer liquidity. If you did not want to, price would have easily taken it out without going through the troubles of engineering liquidity. Okay? So whenever there is no inducement close to your point of interest, it doesn't mean that the POI there will not work. You just have to be patient and you have to pay attention to see if price is going to engineer liquidity or not. All right? So in the absence of inducement, the first time that price will retrace should not be your business. That is not when you should enter. Okay, maybe price comes directly to your POI. That is not when you should enter. That is if there is no inducement, you are aware that there's no inducement and you want to enter the trade. Price may use that POI as the inducement or engineer liquidity. How do you know that price is going to engineer liquidity inside the POI or close to the POI? By waiting. By waiting to see. All right? Waiting to see. Okay, like here now. Price obviously engineer liquidity. You are waiting at this POI. Wait to see how price gets there. It's that simple. All right, it's that simple. Wait to see how price will get to the POI. Now, another form of engineer liquidity, which personally I don't even like it, even though sometimes I tend to trade with it, but I don't like that concept of, but I still use it if the opportunity comes. So sometimes when there is no inducement, price even don't engineer liquidity, price takes out the POI. All right. Either closes inside the POI or above the POI. Then reclaim the POI for continuation. So price is basically taking out the POI as liquidity first, that is stopping out some traders, especially those with their stop loss inside POI. Some people will take entry and place their stop loss inside POI. Sometimes I find myself in that kind of situation as well. And sometimes after I've hit stop loss, that's when I realize that, oh, this is what I actually did wrong. Nobody's above mistakes. So price will first take out those that their stop loss is very close to the POI. That will now fuel the move to the upside. So sometimes price will just come back with the candle and then up it goes. Or retrace properly. Like retrace properly back to the POI. Some people call this is it QMR or what do you guys call it? I don't trade with those. So now the high probability for this trade to play is if price don't close below the POI. Price should close inside or above. If price eventually close below the POI and still play out, that means there's another POI below it. That means there's another POI below it that you were supposed to use and not here. Okay? That means there's another POI below it that caused the move. Like here, for example, let's go to 1 now. If you look at this place, that is why I tell you that it is more important to see how price gets to your entry than price coming to your entry itself. Now look at this. Somebody is going to buy here. All right. What happened here? No inducement, no engineer liquidity. Price came all the way straight down, but you have a limit order there set. Nothing to foil your trade. Now, after price cleared it, closed above it, pay attention to this candle that came into it. A candle came into it to mitigate the actual POI that was cleared out. So stop losses were swept here. Liquidity was properly taken here. Liquidity was properly taken here because a lot of people will set their stop loss below here. The price is going to protect below, just like that. So how do you know that price is going to sweep this POI? Obviously, there is no inducement, no engineer liquidity, and you want to just buy from a POI. No. Price will either sweep it or engineer liquidity. It's that simple. Let's check for another example. I think I saw another example. One of them that I traded with. Let's go to 30 minutes. Do Asian session. This is an example when I actually caught the buy, even though price still tried to manipulate it again. Look at this zone. When price was coming down. In fact, I don't know, some of you that are in my Telegram channel, the old one, when I talked about price buying at this zone, when price was still around here, I told you guys that market is going, price was going to buy. And then something happened, market started selling. And then some of you started leaving the channel. Like, at the end of the day, the buy still happened. What happened here? No inducements, no engineer liquidity. Price came straight. There's no need for you to try to catch a falling knife. Cleared out, people that have bought here can see the reaction, the aggressiveness. The price used to close above it. And then before it came to properly reclaim, even tried again to drop some people here. So please, how price gets to your POI is more important than even the POI you are marking, that you are boasting of. The POI can just be violated. There are people that bought here. Oh. See, there are people that bought here that set limit orders to buy here. There are people that set limit orders to buy here. No obvious inducement, no engineered liquidity because they want to buy, because they saw a POI and they want to enter. So that for engineered liquidity. I think I will just take 3 or 4 questions, two or three questions. But let me stop my recording first.